Hello. Okay. Hi, everybody. So I am Tyler. I want to get a good feel of who I have in the audience here. Is everybody technically related in their role? Like we're web developers, we're data scientists, we're some form of engineer. How many of you are doing something technical within your day to day? Okay, so the majority. So if you want to leave, you totally can. This is not going to be technically inclined. This is going to be venture capital. I just want to make that clear. Do not feel bad if you get up and leave right now. That's totally fine. But yes, I'm Tyler. My name is Tyler Richards. I am with a venture fund and firm called Startup Ignition Ventures. First, for the important stuff, here's my family. I'm married. I have three kids. I love art. I love technology. I love business. I love pickleball. I love golf. Happy Masters Week to those who follow the Masters in golf and the PGA Tour. I'm a little bit obsessed. That starts today. I'm originally from Seattle, Washington, moved to Utah for BYU and never left. Now to the unimportant stuff. I do want to establish a little bit of street cred just so you know who is this guy talking to me. So I grew up very creative and, first messing around with computers with Paint, Microsoft Paint in like 1995. Fell in love with art and digital art, got into, the Flash suite and Corel Draw, if you guys remember those programs, then eventually transitioned into the Creative Suite with Adobe and got really good at, Photoshop and Illustrator and finally transitioned that later into my later high school years and early college years into web development and front end web development. And I basically took on a lot of contract jobs during my college career and basically realized, hey, why am I doing this for other people? I'm just going to build apps and websites for myself. And so I started kind of down the entrepreneurial route and got into iOS development back in 2008, 2009, right when the App Store came out. Eventually started a few companies. Oddly enough, just what the last presenter was about, I actually worked at a very early stage for genetic biomarker and analysis web-based software back in 2000 and kind of ahead of its time. We didn't have AI and a lot of the machine learning that we have today, but that was an awesome experience. But for what I'm kind of mostly known for and what I kind of want to tout in front of you guys was I started a coding school. When I graduated from college, I got really plugged into the startup ecosystem here in Utah. And I quickly realized that almost every startup founder or business owner had absolutely no technical chops whatsoever. And they were great idea guys, but they couldn't actually build the ideas that they had in their head. I thought it's time to skill up these guys. It's time to skill up these founders and business guys to be more technically savvy. And so I started a coding boot camp with another co-founder, another business partner of mine that was called Dev Mountain. I don't know if any of you have heard of Dev Mountain in the past or before, just being probably in the technical arena and the ecosystem here in Utah, you probably have heard about it. And I did that from 2011 to 2016. In 2016, I actually ended up selling that school to a larger education company. But it just taught, basic boot camp esque type education in web development, data science, iOS application, UI UX design, kind of the more modern, technical skill sets that are prevalent in today's, business world. And it went really well. When I sold that company, as every founder or a person who comes across a liquidation event like that does, I turned around and started investing in other founders and other companies. So I kind of made this transition from founder to angel investor to now what I'm doing today is I'm running a venture fund. So I formalized it into an actual fund where we are a venture capital firm called Startup Ignition Ventures, and we invest in really early stage tech companies. So I've kind of had this unique perspective of being one, a founder, two, an angel investor, and three, now an actual VC, self-made VC. I'm not a financially minded individual where I live and die in spreadsheets and financial workbooks like a lot of the VC ecosystem is. Today, I kind of wanted to talk a little bit more about, you know, what is it that investors look for? What does that VC landscape look for? Like John said, I don't know if you guys have side projects, if you've ever given the startup run a real run in your life, or if you've ever had a project that you said, man, if I could just get this to market or raise some capital behind this thing, it could be a thing. And I'm not here to turn you away from whatever it is that you're working on today, whether that be a job or a steady, awesome income or a different project that you're doing. I just want to give a little bit of insight into the Utah VC ecosystem. So to first understand what investors look for, we kind of have to understand the different type of investors, because the biggest mistake I see when going into VC capital or to fundraising is you're going into the wrong type of investor for the type of project or product or stage of company that you actually are in, right? I see really early stage founders or really early stage business guys or tech guys go to very late stage VCs, and that's just never going to happen. And so they go and hit pavement, they talk to 30 investors, and they don't have any success because it's just not aligned. So to start learning about what investors look for, we have to learn about the different types of investors that there are. And I've kind of put them on this spectrum here, which is we're kind of going from the least sophisticated investor to the most sophisticated investor. This doesn't mean the size of fund or the check size that they write. It's just about the sophistication you as a project or you as a startup have to be able to land and match with that type of sophisticated investor. So on the very bottom, we have family and friends. And some people say family, friends, and fools, right? Because we go to Uncle Dave or we go to Grandpa Charlie or we go to our dad John and we say, hey, give me $20,000, give me $50,000, give me $100,000, give me $250,000 to go and execute and do my first round of funding on this idea or this startup. And those are the least sophisticated because usually they're just close relationships to you and you're able to tell them about what you're doing and they just trust you right away. And they say, my son Tyler, here you go. Here's $100,000. Go do what you want to do, right? So then the next step up, we have angels. Again, what I did after I sold one of my companies, I had a little bit of extra cash. I said, I'm going to turn around and invest in the next wave of entrepreneurs and startups. And I really didn't know what I was doing at the very beginning. I was fortunate enough to have my father, who was also an angel investor. He had been investing for 20 years at that point here locally in Utah and up in Seattle, where I'm originally from. So I got a little bit of knowledge and a sped up education in angel investing just because I was investing closely with him. But angels are also less sophisticated because they're usually just individuals who are high net worth individuals that have a little bit of extra cash. They're your dentists, your doctors, your tech entrepreneurs, those who have a little bit extra cash and they say, here you go. Then we go up a little bit more. We go to family offices that are usually those high net worth individuals, but they have put an investor type or a financially minded person over their money to manage it. So they get a little bit more sophisticated. Then we're getting into corporate venture, institutional investors, seed and growth VCs, like actual venture capitalists. Corporate venture is like Caterpillar tractors or John Deere tractors or Nike. All of these massive brands have extra cash, and to grow more, they actually create these venture capitalist funds, and that's called corporate venture. And they're getting a lot more sophisticated than family offices or angels. And then we move up to actual venture capitalists, and they have teams of due diligence and interns and analysts that are all built around analyzing each and every deal. And so you can see as we climb up all the way up to the public markets, private equity, public markets, you're going to be scrutinized more and more and more on sophistication of how complex or how well baked is this idea? Is this something that you wrote down on a napkin? Or is this something you have a ton of traction on and you vetted out and validated, right? So that's the difference. So just to start there, these are the different kind of investors. Obviously, myself and being a venture capitalist, I have my checklist of things that I'm looking for, right? My thesis, my strategy behind what I like to see in a typical deal, a typical startup, a typical investment. But I can really boil this down to one line item. And that is what I talked about with family and friends. It's literally just trust. Because with any investor, if I'm bringing an opportunity to them, they have to have the confidence to know, okay, this is something worth investing in. Obviously, that confidence or trust is different levels based on those different investor types, but it boils down to Am I exuding enough confidence around this deal, around this opportunity, around this idea, around my startup to make it investable? But how do you get that trust? How do you get that confidence with someone you don't know, or an investor you just met at a meetup, or someone you just cold outreach to? I like to base it around validation, validated business models, right? And what does that mean? At Startup Ignition Ventures, that's what we invest in. We're an early stage venture fund. We're a pre-seed venture fund. A pre-seed means in the category or the stages of venture capital, we're usually the very first check. We're the very first stage. And we invest in pre-revenue, even pre-built product ideas, meaning there's no product even built, but we invest and look for validated business models because you can validate an idea with the customer market that you're going to serve or sell to without any capital or any money. It's just time and effort, right? Let's say I have an idea of creating a software that does genetic analysis on genetic testing data. Okay, I need to go and talk to the people who would use that software and talk to them about my idea, about the feature set, about what I'm wanting to build, and validate if they will buy it or not, right? And that's what we invest in. But let me explain a little bit more about this. There's something that I've created that's called the Startup and Investment Roadmap. The startup and investment roadmap is how a startup progresses or a business idea progresses and the stages of investment that exist there. On the bottom line here, you can see that it's time moving forward, right? So on the very, very left, we have the very beginning of your idea or your project or your software or whatever you want to build, the product that you want to bring to market. And then on the very right is a very mature idea. At the very beginning, it's just an idea. Then you start, and in the idea stage, it's hypothetical, right? You're thinking about something that you think would work, that you want to sell or that you want to do, right? You're hypothesizing about, okay, I think this is what the market wants. I think this is the product I need to build. I think this is the feature set that I need to have to make that viable. And then in the modeling stage, you actually go out, talk to customers, and start putting that product together. You start putting the feature set together. You start putting that model together. And then you start getting and onboarding actual traction, actual people, actual customers, actual clients, and you start validating that go-to-market strategy and that go-to-market fit, that product market fit, right? Does your product match what the market actually wants, right? So these are just the stages of a startup. As you go along in time, from a napkin idea down to actually creating revenue, you're de-risking your idea. You're de-risking your startup. You're de-risking your product, right? The opportunity for that investor. And as you're de-risking, you're building confidence, right? That trust, that confidence that we talked about. That's how you pitch an investor. That's how you get investment dollars into your project, right? So as confidence goes up, typically the investment size follows right along with it because it becomes a more mature, more secure, and higher confidence opportunity for the investor. Where do these investors fall within these stages of a business? At the very beginning, again, in the idea stage, typically your grandpa Joe is going to probably take a pretty risky bet on you versus Mr. VC in New York, right? Your grandpa Joe knows you better. He says, hey, Tyler's a great guy, stand-up guy. I know whatever he does is going to be successful. Here you go. Here's $50,000 versus that VC in New York. He's going to say, kick rocks, buddy. This is just a napkin idea. I'm not investing in that. There's no traction. There's no validation. You've done no work on this thing. Once you get into the modeling and traction phase, you can actually start going to real dollars, right? You can go to those angels. You can go to pre-seed venture funds like ours. You can go to family offices, those corporate venture opportunities, or even federal grants or state grants, right? Then as you actually get into the building phase where you're building out the systems, you're piling on customers and you're scaling that project or that idea, you can get into really high dollar traditional VCs or PEs, private equity. This is the investment and startup roadmap. That's what I call this. As you get more investment, you get more revenue. As you get more revenue, your deal becomes more valuable. And that's how wealth is created, right? In a nutshell, this is the quickest, fastest way to get wealthy in America, right? The American dream, right? That's what we all are probably in this room for, is just to create wealth and prosperity for our families, right? So how do you do this correctly? Part of the Startup Ignition ecosystem, our venture fund, we've actually created a startup bootcamp, which teaches these principles, how to go through these phases of a startup, how to take your idea from just an idea into fruition, into market, into building, into scaling, all of those buckets of the life cycle of a startup. Um, I'm not here to sell you on that. But again, it's focused around product market fit, which is that validated business model. We help founders, idea generators, technologists, business people to get from the idea phase all the way through a successful startup. Let me tell you one story, because markets do affect the VC economy and the VC markets. Meg Whitman was a former CEO of eBay, a very high-powered businesswoman, went through a ton of different CEO positions, and Katzenberg was a very high-powered Hollywood producer. So they got together and they said, we're going to compete with Netflix. And right out of the gate, they couldn't call it New TV; it was trademarked, so they had to change the name to Quibi, like week 2 of their project. But anyways, they were very famous, and this was during very frothy market times where money was flowing, pre 2020, pre 2021, and they ended up raising $2 billion on just an idea. Right? Remember, I just told you, how do you raise that kind of or instill that kind of confidence or that kind of investment dollars on just a napkin idea like this? Well, these guys were, one, in a very frothy market, a high peaked out market. Two, they had connections and had high trust and confidence from their peers and the investors that they were talking to. There was a startup guru by the name of Steve Blank who looked at this fundraise and said, man, this company just raised $2 billion pre-product, pre-revenue, just a napkin idea. How is this going to end up for them? And sure enough, in about the time of about 7 months, Quibi raised $2 billion, spent it all, and went out of business. And this guru, Steve Blank, very famous in kind of the lean startup ecosystem, if you're familiar with the startup landscape, he said, wow, so it does matter. Money's not the answer to everything. That validated business model, actually checking with your customers and the market and getting product market fit, does matter. So money can't just, spend your worries away or make your business smart or make your business better or provide wealth for you. It's about actually having good business. And that's kind of what we're in today. You can see on this chart here kind of the peaks and valleys of a lot of the cyclical macro economy that we've experienced over the last 40, 50 years. Again, Quibi raised money in a very frothy, peaked out macro economy. And venture is just like any other asset class. When times are good, times are good. And when times are bad, times are bad. Money's tight. And right now we are in a more down, valleyed out economy in the macro sense and also in the venture capitalist sense. In times or peak markets, bubble era type shortcuts can exist where you can go and raise $2 billion on a napkin idea. But when we're in down markets like how we are kind of today, I'm a lot more optimistic about 2025 than I was 24 or 23. But in down markets like today, it is about the age-old basics, just fundamental business model validated, product market fit, good ideas, right? And that's how you go to VCs and explain your story, show them the work that you've done, and that's how you raise capital. And if this seems like a lot, that's totally okay. There's something that I know in this room, a lot of technically minded people, and even myself, like a lot of times I'm very risk averse. And sometimes I'm very risk tolerant. It kind of depends on the subject matter or what I'm trying to do and accomplish. And there is a risk tolerance spectrum, right? Entrepreneurship or, going off and doing your own business or starting your own startup, it takes a lot of risk tolerance, right? On the right here, you can see being more risky, and on the left you can say being more safe here on the spectrum. And it's totally okay to be in the tech field and working a very steady and at a later stage business, a very mature business like Pattern here or Amazon or wherever else you might be, and that's totally awesome. And that's for those that might be a little bit more risk averse. But if you're in the middle or you have a little bit of risk tolerance, there are opportunities in the startup world to go join a startup, to go work at a startup where maybe you're getting a little bit of ownership or you're getting a little bit of the rock or a piece of the pie, and where you can put yourself a little bit ahead with that wealth creation, where you don't maybe have to be so risk tolerant and super risky and going off and starting your own business or being your own startup founder and doing your own idea, right? There's a spectrum, and that it's totally okay wherever you fall on the spectrum. So I'm not here to convince anybody otherwise. However, if you do like to work at startups, I have a lot of startups that are looking. This is the wealth creation, right? We can look at a lot of the wealth creation in America, and a lot of them are business owners, entrepreneurs, startup founders that have gone and done their own thing and held a majority of ownership and a piece of that rock. And at the end of the day, when those liquidation events have come, they were the biggest benefactor of that, right? That's all, folks. So hit me up, Tyler at startupignition.com. Maybe I'll open it up to questions. John, do I have more time or is that about it? 5 minutes of Q&A if you even feel it. I know I'm not that cool.